Hello friends and welcome back to the channel. Today we're going to talk about something pretty serious from the FDIC about our banking system. They've reported a massive $517 billion in unrealized losses, and 63 banks are teetering on the edge of insolvency. This sounds scary, but is it as bad as it seems? Let's break it down and see what this means for your money and your investments. The FDIC's latest report reveals that US banks have lost $517 billion in unrealized losses. These losses come from the difference between what banks paid for securities and their current market price. Most of these losses are tied to residential mortgage-backed securities. When interest rates rise, the value of the securities drops. This has been happening since early 2022, when the Federal Reserve started raising interest rates. Think of it like this. If you bought a house for $300,000 and the market value drops to about $250,000, you have an unrealized loss of $50,000. But you don't actually lose that money unless you sell your house at that lower price. Banks are in a similar position with these securities. When interest rates go up, the fixed return from these mortgage-backed securities becomes less attractive compared to the new securities issued at higher interest rates. This drives down the market value of the existing securities. Banks don't have to sell the securities right away. They can hold on to them until they mature, which may be many years down the line. But if banks need cash quickly and have to sell these securities, they would have to realize these losses. So the losses are on paper for now, but could become more real if banks face liquidity issues. So what does all this mean for you? Well, if banks start selling the securities at a loss, it can impact the stability and the broader financial ecosystem. It's important to compare this situation to the 2008 financial crisis. Back then, the problem was credit risk. People couldn't pay their mortgages, so banks lost money on these loans. Today, it's about interest rate risk. The value of long-term securities that banks hold have dropped because of rising interest rates. Right now, 63 banks are on the FDIC's problem bank list, up from 52 from the last quarter. This sounds bad, but it's only 1.4% of all banks, which is actually pretty normal. The FDIC says that the banking system isn't in immediate danger, but there are still risks from inflation, market volatility, and geopolitical issues. Just like in 2008, a few banks can drag down the entire financial system. But it's important to note that not all banks are in trouble. It's like having a few bad apples in a large batch. They need to be dealt with, but it doesn't mean the entire batch is bad. So what can we learn from this? Well, the health of a few banks can affect the entire financial system, but it doesn't mean we're heading for a total financial collapse. Now let's talk about the impact on you and your investments. When the government steps in with programs like the Bank Term Funding Program, or BTFP for short, it injects liquidity into the system. This can push up asset prices. For example, after the BTFP intervention in 2023, the S&P 500 rose by 27%, the NASDAQ by 50%, and Bitcoin by 215%. This shows how strategic positioning in response to liquidity changes can lead to significant gains. But imagine if you knew another major rainstorm was coming. You could either stay inside and avoid getting wet, or you could collect rainwater for future use. Knowing how to navigate these shifts can help you turn potential crises into opportunities. By understanding the liquidity flows and market movements, you can make informed decisions and potentially profit from these situations as well. So how can you benefit from this? Well, firstly, staying informed about your financial developments and being ready to act on them is crucial. For example, if you see the government injecting liquidity into the market, it might be a good time to invest in assets that will benefit from this change. From the 2008 crash, one lesson is to stay vigilant and proactive. While your money in the bank is likely safe, its value could decrease over time because of inflation and missed investment opportunities. Investing in hard scarce assets that benefit from liquidity injections like tech stocks or cryptocurrencies can offer protection and growth. Staying informed about financial developments and being ready to act on them is crucial. The FDIC report highlights the importance of a resilient investment strategy that can adapt to market fluctuations and capitalize on emerging opportunities. Think of it like a game of chess. You need to anticipate your opponent's moves and position your pieces accordingly. By understanding the financial landscape and acting strategically, you can protect your assets and even turn challenges into opportunities. So what should you do next? Well, stay informed, understand the data, and strategically position yourself to turn challenges into opportunities. Don't let fear drive your decisions. Instead, use this information to make smart investment choices. Well friends, if you found this video to be helpful, give it a thumbs up and share your thoughts in the comment section below. And don't forget to subscribe for more such insights and updates on the financial markets. Until then, stay safe and I'll see you all in the next video. Bye for now.